Hello everyone, Isaac Jonas here from Streetwise Economics. Today we are diving into why most investors fail and how you can avoid these pitfalls as we look into the financial landscape of 2025. We'll back this up with statistics from credible sources. Remember to subscribe for the free newsletter at Streetwise Economics and hit the subscribe button so that this content can reach far and wide. Now let's get started. Mistake number one. Emotional decision making. The question I mostly get from people that I coach is like, how does emotions lead to investment failure? Now, emotions drive about 41% of investment decisions according to the Bankrate statistics, often leading to panic selling due to fear of missing out in terms of buying. This behavior can result in people buying high and selling low, which is the opposite of how you can make money in the market, right? So, in the increasing volatile markets, in my view, in 2025, due to the potentially because of the incoming administration of Trump and also quite a number of geopolitical issues that might cause some increased volatility. And generally, markets, they don't go up in a straight line. So maintaining emotional stamina that allows you not to just react to every news item that you see can potentially propel you. So one way to manage this is through automated investment strategies. For example, for me, I like to just buy into exchange traded funds, right? Each time, let's say they drop by 2%, right? Because time in the market beats time trying to time the market. So that means for me, I'm not really moved by what's going to happen. So that's one way. Now, another example is during the market dip in 2023. I remember I was in Washington, D.C. The market dropped due to the yen carry trade. That is, investors were buying, who were borrowing money in Japan and then investing in US denominated securities, right? Started selling off since the Bank of Japan had signaled potential change in interest rates in an unfavorable way for those borrowers, right? They started selling off, but quickly the market recovered. Now the S&P 500 has been up about 28% since the beginning of the year. So those people who panicked, they missed the subsequent recovery as an example. Mistake number two is chasing get-rich-quick schemes. I don't know why people think that it's very easy to make money in the market. Another frequent mistake, like I've said, which tempts a lot of people, is this idea of wanting to get rich quick. A study by Delba showed that the average equity investor underperformed the S&P 500, which is the broad 500 big capitalist companies in the US that are listed and weighted according to what the S&P 500 committee decides. These people, they trail the S&P 500 by 5% annually due to trying to chase high risk, high reward opportunities without doing due diligence. So as we head into 2025, my plea is for you to remember that consistent, steady growth often beats speculative gambles that may never happen. So take, for example, the crypto boom in 2021. Many jumped in at the top, and most of those people, they panicked when the crypto dropped by over 10%, right? But now the crypto has gone past $100,000. So this is one thing to be particularly careful about as an investor. The other commonly frequent question that I get is most people misunderstand the risk. So what most people do is that many investors don't understand how to manage risk properly. So a survey by Charles Schwab found that only 39% of Americans feel confident in their ability to manage investment risk. So with this financial landscape shifting more towards digital and global investment by 2025, understanding risk tolerance and diversification is very vital. Not all risk is bad, of course. It's about managing your risk to match your investment goals. As an example, in 2020, when the COVID epidemic caused the market crash, those people were diversified, performed better than those who were over-concentrated in, let's say, the tech sector, even though the market corrected and then went up after the bear market. So the idea is that if you manage your risk, it means if the market goes up or down, still on average, your ability to beat the market will be elevated, at least from my experience. Now, another mistake, number 4, that I commonly get from most investors is that neglecting long-term planning. Why is long-term planning overlooked? The temptation of quick gains often overshadows long-term strategy. Yet JP Morgan's guide to the market shows that the long-term investing typically performs short-term trading. A lot of traders, 90% of the traders lose their money, blow their accounts in the first 90 days of their trading, right? So what that means is that even though a lot of them will have profitable trades, one or two, losses may potentially blow those accounts. So risk management is very, very important. But if I am planning for the long term, like I said, I can just automate and invest for the long term. Those potential market dips, I would be buying only wonderful companies. And for me, I mostly invest in the S&P 500. And remember, this is not investment advice. I'm just sharing my experience. So those investors who hold on to the market for the long term, they've been shown to make money over the long term. Now, not acting like big institution is like another big mistake. For me, when I'm investing, I like to think like how big institutions, think. So individual investors like me often fail by not thinking and acting like big institutions such as banks and pension funds, which really move the market. These entities focus on asset allocation, risk management, and patience. They are not swayed by daily market fluctuations, but by strategic long-term market trends. If the small retailers like me mimic this approach, we could benefit significantly from the same market focus to drive institutional, like what institutional market makers or institutions do. For example, some institutions, they just have like hedged portfolios, but when you look at it, if they are making money consistently from across different markets, the commodity markets, equities market, the gold markets, because sometimes different markets, they may be performing differently. And of course, they have more capital. So these are the common mistakes that I want to share with you. And also, it's important to get started, but to educate yourself. That's what I do when I coach people. If you want to reach out, feel free to reach out to me. But for now, there you have it. Some of the reasons why investors fail and why you can sidestep these common traps. If you want deeper investing, like I said, and you need personalized investment guidance, reach out at www.streetwiseeconomics.com for one-on-one coaching. Don't forget to subscribe also for my weekly newsletter where I share financial insights. Thank you so much, and let's make your investment journey a success in 2025 and beyond. Bye-bye for now, and thank you for tuning in today. Remember to trade and invest wisely, as investing is a marathon, not a sprint. Keep these lessons in mind, and you'll be better positioned for the challenges and opportunities of 2023. See you in the next video. Bye-bye for now.